Hi, today our group gonna make a presentation based on the consolidation accounting and the equity method. Firstly, I will compare consolidation accounting with the equity method and illustrate their differences and their similarities. Then Mike will explain how managers purely benefit from taking the equity method instead of consolidation when the determination of control and the significant influences is unclear. And the error will conjecture several mechanisms or solutions that could reduce the potential manipulation. And finally, Jackson will analyze whether it is preferable to adopt a unified accounting method for equity investment, regardless of the level of influences on the investee. First of all, let's look at their similarities. Adopting both methods will not affect the individual financial statement of investor or investee. And both methods have not continuity, which means whatever manager adopt either one, they need to record both current data and the effect of historical data. In addition, the purpose of taking both methods is similar. If the company only reports its own business but doesn't adopt either method, the company will not be able to provide sufficient information to shareholders and potential investors. It's because the business nature and the potential risk of company cannot be reflected and predicted precisely from those individual financial statements. So taking the consolidation or equity method aims at determining the financial position of the entire group and still keep tabs on the individual performance of each business entity. And on the other hand, the main differences here could be the way of measurement. Consolidating the financial statement include combine the firm's income statement and the balance sheet together to form one statement. This method provides a more accurate and detailed record because it breaks down the performance of the joint venture. And it allows each company to see the operational efficiency of each step in the joint venture process and identify the potential risk of profitability arising from the factors like production costs, shipping costs, or profit margin. But the equity method doesn't combine the accounts in the statement. It records the investment as asset and accounts for income received from the subsidiary. Firstly, the investment is recorded at cost, and then adjustments are made either up or down, depends on the venture's current value and the expense associated with it. And the income earned on the investment must be recorded on company's income statement. And the value reported by each company represents only by the firm's relatively share. And then let's welcome Mike to explain how manager benefit from taking equity method instead of consolidation when the determination of control and the significant influences is unclear.
I will explain how managers can privately benefit from choosing equity method over consolidation when the determination of control and significant influence is unclear. APP Opinion 18 describes the significant influence and defined that an investment of 20% to 50% indicates significant influence in the absence of evidence to the contrary, and an investment of less than 20% indicates that an investor does not have significant influence unless it can be demonstrated to exist, while in the real world, the determination of control and significant influence is not that easy to make clear its uncertainty. The ambiguity of the judgment boundary of significant impact makes it easy for enterprise management to use the equity boundary of 20% to 50% to manipulate for their own private gains, making an artificial choice between the equity method and consolidation method. For example, the company can use the agreement to control the invested company, but maintain less than 50% of the voting rights. The company can use contracts to achieve these actual control capabilities, but when making external financial reports, if the voting right of the company with actual control are less than 50%, the company can formally deny the control rights it has and only recognize that it has a significant impact on the invested company, so as to realize the artificial choice and use of the equity method and not the consolidation method. According to the definition of consolidation method and equity method, it is good to see that consolidating financial statement provides more accurate records because it deals with the operating performance of subsidiaries in detail. While it is easy to see that there are many theoretical and practical defects for equity method because this type of method does not consolidate the accounts in the financial statements. It only regards the investment as an asset and records the income received from subsidiaries, so that the enterprise managers can easily take advantage of this defect to seek their own private interests. When the enterprise managers using the equity method, they benefit from inflated profit and the off-balance sheet financing, which effectively enhance firms' financial ratios. If the equity method is used in the accounting of long-term equity investment, the profit of the investing enterprise includes the investment income increased according to the shareholding ratio and according to the changes in the equity of the invested company, but in fact, the investing company may not have the actual cash flow. Meanwhile, if the equity method is adopted, the investment company does not need to consolidate the asset and liability accounts of the investee, so it can easily realize the off-balance sheet financing. The off-balance sheet financing covers up the important financial information of the enterprise, such as the real debt ratio, coupled with inflated profits, which can greatly increase the return on assets, and the liquidity and the return on sales, while the debt and equity of the enterprise are significantly lower than the actual situation. The enterprise managers can mislead information users by making the enterprise situation shown in financial report too optimistic. The excellent financial report makes investors chase the enterprise very much, and the board of directors will trust the managers very much. So they may give these managers more power and more returns. When the manager's power is covered up, they can freely conduct more private transactions to misappropriate enterprise property, such as transferring enterprise assets to another company under the name of insiders and pretending to be an investment and so on. And let's move on to the question 3.
Hi, my name is Aaron, and I will be doing the third question of today's presentation. There are three possible mechanisms that can be helpful for mitigating potential manipulation. Firstly, empower auditors to review and challenge. For example, when the financial statements are being audited, the auditor needs to review whether the methods used in the financial statements are reasonable. The auditor needs to make a case-by-case analysis to review whether the company's current accounting methods, such as consolidation method or equity method, are appropriate. Secondly, the rules and the accounting standards should be cleared and restricted by the enterprise. For instance, it can be stipulated that the consolidation method must be used when the holding reaches 50% and the control is obtained. Furthermore, according to Gonzalez, an incentive can also be an effective solution to mitigate the potential manipulation. It is stated that incentives to manage affiliates' earnings can alter the impact of equity ownership on affiliates' signed discretionary accruals and confirm the importance of considering investors' characteristics when studying the impact of major shareholders on investing. Moreover, in the case of public affiliated companies, the lack of transparent information provided by investors can be alleviated by reviewing the financial statements of the public affiliated companies. Thus, equity method investors might have a stronger incentive to manage income from private affiliates, which would be more difficult to detect the earnings management. Some private affiliates may be subject to less auditor scrutiny. For instance, a demand for audited financial statements may not be required by a 50-50 joint venture with no debt financing. When there are no auditors reviewing the related financial statements of the affiliate, the detection of earnings management might be avoided more easily. In conclusion, there are several mechanisms like strengthen the auditor's function, standardize rules and standards, or some incentives that help mitigate potential manipulation, while different solutions needed to be used according to different situations. That is all for my today's presentation, and Jackson will continue with the next one. Thank you for listening.
Hi everybody, my name is Jackson and I'm going to handle the last question of the presentation, which is discuss whether it is more desirable to require uniform accounting treatment for the active investments regardless of the level of influence the investor holds on the investee. So from my perspective, the general answer for this question is no, and I'm going to give you some reasons about it. So here we can see that there are two disadvantages of the active method. So firstly, it needs to remeasure the cost of long-term investment from time to time, which will increase the workload of accounting a lot. And secondly, investment income is the net profit of investment object, and net profit is only paperweights, which means that cash will not be received if dividends are not paid. As a result, for the subsidiary under control, active method is not necessary and it is also not appropriate. Since you already have control over the subsidiary, then you will be responsible for most of its profits and the losses caused by the operation, which means you don't need to remeasure the investment cost constantly or record the fluctuations of yields. So in contrast, the application of active method is used for the accounting of long-term active investment of firms, which usually accounts for about 20% to 50% of the shares. And in this situation, you will not have control over the company, but you will still have the significant influence on it. So what we need to be careful when we do investments is that we should always think about investments carefully, and we should always record the changes of the returns on the investment. So in conclusion, we should do the analysis case by case instead of applying one method in all situations. And we should not make sweeping generalizations when conducting accounting problems. Okay, that's all for the question 4, and that's all for our presentation. And thanks for my teammates, and thank you for your watching, and hope you can enjoy this video.